Welcome, everyone. My name's Neal Bawa, and I work for two companies, Mission 10K and Grow Capitalist. These are two data-driven real estate investing company. My co-pilot today is our COO, Anna Myers. Anna, say hi.
Hello, everyone.
And our topic today is real estate trends and best cities to invest in. This is the mid-year update. We do this twice in a year. So today we're going to dive deep into the numbers and we'll give you a sort of a clear picture of what's happening both in the economy and in real estate. So get ready to dive in. There's a ton of content. Most of you know us, but for those of you that don't know Anna and I, we're quirky, very opinionated data scientists and technologists. We buy and build large projects, and our portfolio of 31 properties in 1,700 metros used to be worth $1 billion. We sold a bunch.
1,700 metros? Wow, that is a lot of
17
metros.
Oops, 17. We'll get to 1,700 someday. 17 metros used to be worth $1 billion before we sold off a bunch of properties. So that slide needs to be updated. We're roughly worth about $650 million today. We both like to build and buy properties. This is one that we built. It's in Utah. This is one that we bought and improved that had a 2x return. This one is in Atlanta, Georgia. Midtown Ridge is a current property that we are improving right now. Mill Race is a property that is approaching the end of its lease up. I think it's about 80% leased. We built it in the last 3 years. The Grid has been occupied for 3 years. So this is a brand new property that is currently at 95% occupancy. And the University Oaks is a small property that just hit 90% occupancy. So lots of different kinds of properties in our portfolio. This is our partial portfolio, and we use data science to invest in 8 different asset classes. There's multifamily value add, apartment new construction. There's single family built to rent, fourplex built to rent, student housing, built to sell townhomes, self-storage, flex industrial. So each of these asset classes, it teaches us something different. So hopefully we get better at our job over time, and our job is to protect your investment. Our investors love what we're doing. Here's Jennifer. Jennifer actually met with me last week, Anna, because we did, for the first time in 5 years, we did a meet. So in the stand, she came up to the meetup, gave me a hug, and said, I'm the one that's on all of your slides, and I love working with you. You're amazing. So it was fantastic to actually finally meet her in person. So that's Jennifer. That's her testimonial. And I do want to get the boring legal stuff out of the way before I dive into all the good stuff. So the friendly reminder, this webinar is for educational purposes. And just because, Anna and I are sharing our personal opinions, it doesn't mean you're guaranteed to make a fortune in real estate. Do your own research, consult professionals, and remember that investing in real estate and stocks is risky stuff. And don't be afraid to type in your questions. We're going to do our best to answer them at the end if you have time. And don't worry if you miss anything, we'll be sending out a recording of this shindig probably tomorrow or day after. All right. So I always like to start with what the Federal Reserve's take on the economy is. I tell people there's an obsession with presidents, but the Federal Reserve is much more important. So let's spend a few minutes on what the paper pushers at the Fed are saying. And by the way, what an amazing graphic, right? Our graphics designers are absolutely incredible. So this dude, Ian Shepherdson, is a chairman and chief economist at Pantheon Macroeconomics. And what he's saying is that the May job numbers really kill off any chance of the Fed cutting rates in July. The Fed is meeting next week, by the way. And our base case remains that a run of much weaker print is coming. Now, remember, this guy said this in June, right? When he said it in June, people were laughing at him, right? Because what he said is that there will be a September easing, meaning the Fed will cut rates in September. And now what he's saying is we are looking for 125 basis points of easing this year. You know what that means? 1.25%. That means 5 quarter-point cuts. That's what this dude is saying. But in June, the people that were laughing at him about a September cut, today, Wall Street says that there's a 97% chance of a rate cut in September. That's why I listen to this guy. I think he may be a little bullish on 5 rate cuts this year, but not more a bit bullish than many people think. All right, so here's the dot plot. Keep in mind that the Fed is themselves predicting that insurance will fall to about 2% right here. See this? About 2% by 2026. And I can tell you that the Fed's track record of predictions is pretty awful, but I want you to keep in mind that their inflation predictions are a self-fulfilling prophecy, because if inflation doesn't come down, they basically raise rates or keep them higher for much longer until it eventually comes down. So in a way, they achieve their number by simply manipulating the liquidity in the marketplace. So they have a fantastic track record since World War II of getting inflation down to 2%. So it's very, very important that you should understand that they are in a position to take corrective action until it drops to that level. But usually the Fed ends up putting us in a recession when they do that. So they're great at dropping inflation, awful at preventing a recession while they do it. But at this point, the Fed is actually very bullish, which is a change for them because they projected that 2024 GDP growth for the US, and this is a very recent forecast from about a month ago, could be as high as 2.1%. They actually bumped this number up from 1.4% at the beginning of the year. So they have a growing level of confidence that we are likely to avoid a recession despite such high interest rates. So with the unemployment number having ticked up, this says 4%. We actually are now at 4.1%. The economy has actually proven to be incredibly resilient, and everyone, including the Fed, expects the economy to slow a little bit further in the second half of the year. But the job growth numbers, the unemployment numbers, they're not consistent with a recession in the second half of the year. So that's sort of good news, bad news for those of us that want the economy to weaken so that the interest rates can come down. So we are clearly heading back to a normal level. This is US job openings. They peaked right here in 2022, and they peaked right around March 2022. And interestingly enough, between March and July of 2022 is when we had the highest inflation. Why? Because there were 12 million open job openings. Now, those job openings have gone down to 8 million. Now, what this slide doesn't show you is how many people are looking for jobs. Well, right now, that number, the number of people looking for jobs is also 8 million. So if there was another bar here, these two lines would be touching. And that's the perfect economy. You want the number of people looking for jobs and the number of jobs to be exactly the same. And they rarely ever touch, but they are touching this month, which shows that the economy is cooling at the right rate. And you can also see that wage growth was outpacing price increases for 15 months. So let's say inflation was 3%, wage growth was 4%. And you want that to happen for a while because this section here, right? The difference between inflation, which is reducing here, and wages, this is purchasing power. All of this stuff is purchasing power. When inflation is lower than wage growth, people's purchasing power is increasing. And we needed that to happen for a while because people's purchasing power was negative. Here it's positive. So we're now moving in the right direction. And as a result, we're showing a strong indication for a soft landing in the US economy. If you look at inflation, they measure it two different ways. One's called CPI, the other one's called PCE. And I'm looking at both of those, and they're both showing very good numbers. A lot of people might say, yeah, but Neal, this is still higher than 2%. Right here, it says, roughly 2.6%, right? Yes, but if you look at the 3-month number, the 3-month number is at 1.5%. So the last 3 months, obviously it takes time for inflation to slow down because the rates take a while to push inflation down. But the last 3 months inflation, if I annualize it, we're at 1.5%, and the Fed's perfectly comfortable with 2%. Right? One of the things that we are seeing is this is David Kelly from JP Morgan Asset Management, and once again he's supporting. What he's saying is that the plane basically landed 2.5 years ago, and it's just been cooling down ever since. Right? So they believe that there's going to be a soft landing, and I like to listen to JP Morgan Chase more than anybody else in the U.S. They've proven to be very smart people. All right. So now that was a little bit about the economy, right? So it looks like we're coming in for soft landing. It looks like finally, after such a long wait, and boy, I've been so impatient about this. We're finally getting inflation down below 2% on a 3-month basis, and I think we will get it below 2% on a 12-month basis by the end of this year. So finally, we're there. But there's been a huge amount of damage done. Right? There's been a steady drumbeat of bad news about real estate, especially commercial real estate, apartment real estate. So let's dive into the numbers. And the numbers that I didn't show you at the beginning of the year, I didn't have them then, now are delinquency levels, default levels. What's the comparison between multifamily and industrial and retail and hotels and other asset classes? Let's do all of that. Let's go. So the first thing I want to start with is delinquencies, when you're late in your payment, because that's a leading indicator for what bad things are going to happen in the future. Here is where we were post-financial crisis. So let's say the delinquencies peaked for commercial assets, and these are all commercial real estate. There's hotels are in here, apartments are in here, retail is in here, all of that is in here. So we peaked at about 10.3% of all assets having delinquency, at least 60 days of delinquency, and that was right around 2012. So it took a while for that to happen, right? So here we're ticking up. So this number obviously was extremely low. We're at 4.7%, but keep in mind this is lower than 2014, 2015, 2016, 2017. So it's not a high number at this point in terms of delinquencies. And in the coming slide, I'll show you what the delinquency is for multifamily versus other asset classes inside of commercial. So here is the delinquency for multifamily and where it's projected to be next year. So this is this year, this is next year, and then this is office, right? This gives you a great sense because you're able to compare the two largest commercial asset classes in terms of their current delinquency and their projected delinquency. So this is brand new data that I found from Fitch, which is one of the rating agencies. And they're saying multifamily CMBS delinquency right now is at 1.3%, and it's going to go up to 1.5%. Remember, on the last slide, in 2012, we were at 10% delinquency. So is it ticking up? Sure, 1.3 to 1.5, but that's a very small increase. Now, let's take a look at another asset class in commercial, office. We're already 6 times higher than this number, already 6x higher. And we're going to go up to the point where 10% of all office CMBS loans in America are going to be delinquent. 1 in 10 loans are going to be delinquent next year. That gives you a sense of how different asset classes perform differently. Now, we looked at delinquencies, right? What's the next step? Let's look at foreclosures. How many foreclosures across commercial real estate? Let's look at every type of commercial real estate and see how many foreclosures we had. These are all large assets. So we're not counting, 2 units, 4 units, 10 units. We're looking at big assets, right? So obviously here, you see a spike here. We were up to maybe 800, 900 of those assets, foreclosing. And remember, if it's a 200 unit asset, one asset is 200 units. So if there's 900 of them, you're multiplying, you're looking at 180,000 units. So it's a big deal, right? Now here, we're seeing an uptick. And here you see 2022 very low, right? So this is the pre-pandemic average. So we were at the pre-pandemic average. And then we started to tick up and we're at 635. And this number is concerning because it's clearly accelerating. It could easily cross this number here as well. And so I said, okay, I want to see what kind of assets are these that are actually getting foreclosed, right? And being sold on the county courthouse steps. And the answer is, there's no apartments. All of the foreclosures that were in the previous list were not just office. They were older urban office. They look like this, right? So I'm not seeing a lot of buildings that are in foreclosure that are Class A, brand new, nice looking offices. They're all filled. It's the older offices that are suffering, that are in urban areas. If they're in suburban areas, they're still occupied. But in the urban areas, older offices, they're the ones that pretty much all of the foreclosures are. So that made me feel really good because I don't own any office assets. I own a bunch of multifamily assets and really couldn't find any evidence of foreclosures in multifamily. All right, this slide is technical, but it's a very important one for those of you that are concerned about the future of commercial real estate. I'm going to walk you through it because it's complex, all right? Each bar, and you can see this is office, industrial, hotel, retail, and multifamily. This is the amount of total debt loans that are maturing in 2024 by different types of property types. So there's, office, industrial, hotel. Now, as you can see, $200 billion worth of loans in offices are maturing. That's a lot. And you're like, oh my God, you showed me office is already 10% delinquents. This is really bad. This is really bad. Until you realize that this bar is made up of 2 colors, right? So the 206 is the total number, but you notice what this 89 billion is? It is the percentage of those 200 billions in loans that have been deferred, meaning they kicked the can down, right? So what has happened is only half the year has passed, and pretty much all of the new office loans the office loans that were coming up for renewal that really can't be renewed because the value of the assets has gone down. Guess what the banks are doing? They're being smart. This is the thing that they did wrong in 2009. They called all the assets back and ended up with millions of single family homes. They're not doing it. They're kicking the can down the road. I'm pretty sure by the end of the year, this 89 billion number will be pretty much the whole bar. Because anybody that has an office building right now, if they can pay their mortgage, the banks are kicking the can down the road. Very smart strategy. This is exactly what the banks should be doing. They're doing the same thing for industrial. If loans are coming due, industrial is doing quite well from an occupancy perspective. It can pay its mortgage, but you can't refinance it because the asset values have gone down. So guess again what the banks are doing. $48 billion. We kick the can down the road. Retail's doing much better than you might think, and they're $8 billion worth of those loans are being kicked down the road. Now let's look at multifamily. Biggest bar, $257 billion. That's $250 billion coming up for renewal this year. And you're like, oh my God, that's a huge amount. Multifamily values have gone down. Neal's been telling us they're down 25%. What is going to happen here? You notice only $2 billion out of $257 billion are being kicked down the road. Do you know what that means? Lenders are not afraid of taking multifamily back. What lenders are saying is, go sell your property. It's readily available. You can sell it in the market. I don't care that your investors lose money. I want you to sell your property. And if you don't sell your property, I won't kick the can down the road. I won't adjust your loans. I will just simply take the property back and I'll sell it in 30 days myself. So no lender in America is hesitating to take the keys back from multifamily. And that is an indication of how strong this asset class is. It's also bad news because like everybody else, I'd like some of my properties to get kicked down the road. But from a macro perspective, you're an investor. You have to understand the difference between this first bar on the left, where $89 billion worth of loans are being, pushed down the road, and this bar with only $2 billion. This shows the strength of the multifamily market relative to office, industrial, or hotels, where people are like, yeah, let's give you extension. For multifamily, they're saying, no, I know that I can sell it in 30 days. Just give your property back to me. And that is why there are no foreclosures. Because when a bank says, I won't kick the can down the road, finally, the general partner goes and sells the property. And that's what we're seeing. Let's take a quick look at retail. I've been predicting the demise of retail for a long time, the retail apocalypse. None of those things have happened. And the reason they haven't happened is starting right here, 2008 is the last time we built a lot of retail in this country. Since then, we haven't built much retail. We've actually been very underbuilding. And as a result, retail rent growth is on the upswing and retail vacancies down to only 4%. You'd notice typically they would be at 6 or 7 or 8 before, in this time frame. Now we're down to 4. Why? Because we're not building a lot. And that's why retail is doing really well. Hotels are doing really well. Their occupancy went crazy down during COVID and it's come back up, not quite to where it was. So still a little bit lower, but take a look at their average daily rate. It was already increasing really fast. And then it took a drop, but when it came back, notice it's actually above trend.
Yeah.
This was the original trend. This is the current trend. So full service hotels are up 24% since COVID in terms of rents, and limited service, the smaller hotels, are up 20%. Hotels are doing really well. Now their values are down because of cap rates, but overall, they're cash flowing like crazy. And then of course there's industrial. There's almost no delinquency in industrials, and a lot of that has to do with artificial intelligence. We need about 100 million square feet of additional industrial space in the United States because of AI, because of what happened with AI and ChatGPT in the last 2 years. There's almost no delinquency. Bottom line is, I did a lot of research for you guys because there's just so much stuff on social media. $1.4 trillion in loans coming due. Oh my God, commercial real estate is going to fail. The banks are going to fail. The system is going to crash. Where's the data? Where's the data? Bottom line is, we're actually coming to the end of this really tough time for commercial real estate. And we're in the last 6 to 12 months of the challenges. The stability is in sight and the fears are overblown when I look at the data. The data simply doesn't support any kind of quote unquote meltdown. Yes, there are people that are losing money when their properties are going back to the bank. Yes, there are some challenges in the market and prices have declined. But does this mean that the sector is not stable? There's no evidence of that. Now, before I move on to real estate and tell you more about single family and multifamily prices, this is the question that I've gotten a lot in the last 3 to 6 months. I don't know why people are so paranoid about this. Could commercial real estate distress take down the banking system? Could it take down America's banking system? So I have a few slides on this, right? There are 4,000 banks in the United States, roughly. And this company called Claros did an analysis. There are 282 banks that are at risk because they loaned a lot of money to commercial real estate, whether it's apartments or office or whatever it is. But here's the good news. You see this section here? Only one bank out of 282 is a large bank and is a systemic risk. Systemic risk is a bank which can basically start a run on the entire economy. It can create contagion. It can create the banking system to freeze. One out of 282 is the size that could potentially damage the system itself. It's called New York Community Bank. And the good news is the Federal Reserve knows this, and they have New York Community Bank in their sights. The Fed actually publishes a problem bank list. Back in 2011, there were 900 banks on this list, roughly $450 billion. Okay, today, the problem list, and this is this line here, is at roughly $40 billion worth of total numbers. And there's only about 52 banks on this list. So it's gone up a little bit. So it's gone up by 13 in the last year. So it went from 39 to 52, about 66 billion, not 40 billion, $66 billion in assets. And then there's that one bank, New York Community Bank, which everyone's keeping an eye on. And this is why I don't believe that any kind of banking crisis is imminent. Wall Street knows all of this stuff. We've learned a few things from 2008. Take a look at JP Morgan stock in green. They are up 27% this year. If Wall Street felt that JP Morgan was going to have a problem, 12.5% of their portfolio is commercial real estate, by the way. One in every $8 that they invest is commercial real estate. Look at their stock, up 27%. Wells Fargo has an even larger percentage of their portfolio in CRE. 21% of their portfolio is CRE. They're up 18%. Now, you might say, yeah, Wall Street's dumb. Really? Look at the next one. New York Community Bank. 57% of this bank's portfolio is CRE. Look at their stock price. It's down 66%. Wall Street knows what they're talking about. This bank is in trouble. If you have any loans from New York Community Bank, you really want to refinance them right now. Other than that, I just don't see there being contagion in the economy from CRE loans because the majority of CRE loans are in small banks. Small banks fail all the time. Every year, dozens of small banks fail. The FDIC comes in, 24 hours, the bank shut down. Next day, they open it with a new name and a new buyer. JP Morgan Chase will probably buy every bank that fails right now because they're making such an incredible amount of money. There's no contagion risk that I can see. So hopefully that answers your question. It's one of the popular non-questions that I see on the web. All right, let's dive into real estate. We're going to talk about single family. We're going to talk about multifamily. First thing, single family. I'm a multifamily guy, but I like to talk about single family. I like to track it. Home prices hit a record high in May, right? And this is happening even though inventory is growing. For a while, people are like, there's no homes in the market, Neal. When homes come into the market, prices will go down, they will crash. Really? Inventory is up 18.5%, right? But even then, home prices are up 5.8% in a year. I know this is not fantastic. It's not 15 or 20%, but you realize mortgage rates are at 7%, right? So with 7% mortgages, an 18.5% increase in inventory, home prices are still up 5.8%. The average home price in the United States, which used to be in the 200s just 5 years ago, is now $419,000. And you might say, yeah, only the rich investors are buying. Really? Look at the circle, that red circle on the right. 31% of the people buying today are first-time home buyers. 31%. So no, new people are buying. And people are like, oh, all those cash buyers went away. Really? 28% of all purchases in May, in 2 months ago, 28% all cash, right? Homes, oh, it's taking forever to sell. Really? 2/3 of all homes that were in contract were sold in less than 1 month in the entire country. 2/3 of homes went into contract in less than 30 days, right? Does this seem like a market that's crashing? I believe single family is actually stuck in a bubble, right? So I want to show you this graph. This was single family prices, 284,000, but this is the US-wide price, average price just before COVID, 284. Today, that price is at 393. So you see this number going up like this, right? So huge increases, right? Massive increases, right? And look at mortgage payments though. You notice that this red bar is a lot sharper than this bar. Mortgage payments in the United States, one day before COVID, were about $1,000. Today, they're 2,000. So mortgage payments have more than doubled. They are up 111%, even though incomes in America are only up 19%. Single family is a bubble. When incomes are up 19% and your mortgage is up 111%, that's the definition of a bubble. They're in a bubble because interest rates have more than doubled and home prices have gone up 44% since COVID. The problem is the bubble's not bursting. And it's not bursting because of this concept called the lock-in effect, where you bought your home a while back, you have lots of equity in it. Now you want to sell the home. but you've refinanced it at 3%. If you sell it now, you'll have to buy a new home at 7%, and that's crazy because your mortgage payment more than double. So people are locked in. I'm locked in. I'm at 1.75%. If I sell my home and buy it back the next day for the same price, my mortgage payment quadruples, goes from $6,000 to $21,000, right? So I'm locked in, and the lock-in effect means that even though homes are gradually beginning to come onto the market, we are seeing more inventory. Overall, tens of millions of homes are still staying away from the marketplace. Buyers today must earn $115,000 average in the United States to afford a typical home. That may seem like a low number, but keep in mind that's national. In San Francisco, you need $404,000 in income. In Phoenix, which is supposed to be the cheap place that San Franciscans were running to, it's now up to $121,000. So it's higher than the US average. The US average is up to $115,000, even though the median income, that's the last number. The median income is $75,000. Look at this gap, the widest in history, $40,000 gap between the median income and the median income needed to buy a home. Bubble, hard to burst because of the lock-in effect. Now we come to multifamily. Now we come to apartments. There's a lot of people for years that have said, including myself, that multifamily might be in a bubble of some sort, but that bubble has burst. Prices of multifamily are down 25%. And what's better is the growth in multifamily is balanced. It's incredibly balanced, and I'll show you why. Multifamily rents since COVID are up 19.6%. Let's call it 20%. They're up 20% in about 4 years, so about 5% a year, right? Wage growth in the United States is also up 20%. Look at these two numbers. Basically, rents are going up together with wage growth. So as people's wages go up, they can afford more in rents. That's balanced, 19.6, 19.7%. These two numbers are close together. So multifamily rents are increasing not faster than wages. They're increasing at exactly the same rate, and that's creating balance in the multifamily industry, together with the fact that all properties are 25% cheaper, maybe even 30% cheaper in some markets. And that's bringing balance to the multifamily market in a way we've never seen before. The other thing that's creating this balance is supply, right? Not since this dude was president in the 1970s have we gone above, have we had this many homes delivering or this many apartments delivering. So this year, we're going to deliver somewhere between 620,000 and 670,000 apartments. The real page number is 670 on the screen. There's other, data that suggests that it's 620. So given how high this bar is, look at the orange bar. We should have seen ridiculous negative rent growth all around the United States. Ridiculous rent growth, right? Ridiculous rent drops, because that bar is ridiculously high. But we managed to somehow absorb pretty much all of those units, because while we have slower rent growth, we have not had negative growth in the United States. So I'm very proud of multifamily's performance, because with deliveries like this, the United States still continues to have positive rent growth. Rents grew 0.1% year over year in April. May was around the same number. Actually, it was a little higher. It was around 0.2. So you have to annualize that. You have to multiply it by 12 months. So rent growth is somewhere between 1 and 2%. Slightly anemic, but if you look at the 50-year trend, we're right there. And the fact that we're delivering so many units means, wow, this is actually a time to be proud of the multifamily industry. Occupancies ticked down a little bit. We used to be at 96%, then we were at 95%, we're now at 94%. But we compare really well to office, which is currently at 78% occupied, 78%, where multifamily has gone down 2% in 2 years. Finally, distress. I talked about this before in the distress section, but I wanted to give you one more graph, one nice graph. When you look at delinquency rate, isn't it nice to compare it to other things, right? So that way you can know whether you should be worried. Take a look at individual credit cards. 3.5% of all credit cards in the United States are delinquent as of late 2023. The numbers actually ticked up a little bit. It's closer to 3.5% right now. Auto loans, 3%. Home equity loans, roughly 2.3%. Single family liens, which is sort of regular mortgages, are close to 2%. If you keep going down this list, this is where apartments are, 0.4% bank delinquency. And this is where the rest of things are. Am I worried about credit cards? Yes, there's too much delinquency. Auto loans? Yes. Should I really be worried about multifamily? I don't know. You decide. So to me, this is actually a great, great time to buy multifamily. We are absolutely convinced that rates have peaked. We are absolutely convinced that September is the first rate cut. We believe that there will be 6 rate cuts by the end of next year. 6 rate cuts, quarter point each, 1.5%. So essentially that means that when you're buying multifamily today, you're probably buying it around 6%, 6.1% if you're getting a fixed rate. And we think that that could go down as much as 150 basis points or be closer to 4.5% by the end of 2026. There's a very, very clear trend of that at this point in time. The numbers were sort of up and down for the last 12 months. We were in a holding pattern, but finally we're seeing the data, and the data is very clearly pointing towards a lot of rate cuts. Multifamily is highly discounted, so some markets are 20% off, some are 25, some are 30% off. And then the rent versus buy difference. Remember, single family is in a bubble. That bubble may not burst, it may deflate over time, but I certainly don't think prices for single family can go up when mortgages are already up 111%, incomes are up 19%. All right, I like to finish with a shootout of the best cities in the United States. Now, I look at this list. So the list is the same as the one I gave you in January, but my comments are going to be different. But before I do that, I want to point out to you that we continue to have really high quality projects, both in the new construction arena where we build a lot of townhomes. We think that townhomes are the solution for the affordability crisis in the United States. Unless we all of a sudden magically start building 1 million more single family homes per year, this is really the solution, townhome rentals. And that's a specialty of ours. These are obviously more profitable projects, and we're discovering ways to make them more profitable as we go. We made mistakes in the past and we're learning from them. We also, for those of you that like cash flow, invest in value add projects. Now, these projects that I'm showing you are done. So these are projects that we've already purchased. They're not open for investment, but we do have options open for investment. At the end of this webinar, there'll be a poll, and you can give us, let us know if you're interested in our upcoming projects. So value add projects, new construction projects. I'm going to skip past this one. And so many different kinds of opportunities that are available to you. Peter Majeski is our Director of Investor Relations, fantastic guy, knows all the math, knows all the numbers. So for those of you that are interested in benefiting from multifamily being in a very rare, very unusual balance situation, please have a conversation with him. Anna will put in this link that you see, growcapitalist.com investor-call into the chat, and you can schedule a call with Peter, or you can just grab that barcode that's on the screen. All right. Back to the cities. This is actually one of the most confusing best cities list ever. This is the 10th year that I'm doing this presentation. But the part that's not confusing, so this slide is the one that's not confusing. This is U-Haul 2023 and 2024. It should say this is the 2023 data. The list on the right are the biggest winners. And you notice these are their numbers, right? The top 9. And these were their numbers last year. So you see that number 1 and number 2 haven't changed. North and South Carolina have just switched. Tennessee's right there. Idaho's right there. This is the outlier. We don't know why Washington State all of a sudden is attracting a lot of people. It might be that the Seattle economy is doing well, but we're not sure.
It's because Washington is awesome.
Yeah, just because she just moved back to Seattle. Don't listen to her.
I love Seattle in the summer.
Don't listen to her. But as you can see, the biggest winner list is pretty much stable. The biggest loser list has been incredibly stable because for the last 6 years, number 49 and number 50 are the same 2 states, Massachusetts and California, losing the most number of tenants. California is actually accelerating in terms of how many tenants it's losing. So here's the top 10 housing markets for 2024 list. And so far this list, 6 months in, has proven to be correct. I wouldn't have said that in January necessarily. There are no Southeast markets. Southeast is the hottest part of the U.S. Most population growth, most job growth is in the Southeast. There's no Southeast list, cities in this list for the first time in 10 years, and that's because of affordability. A lot of the markets on this list are affordable markets. Toledo, Ohio is affordable. Riverside, California is an affordable part of California. Bakersfield is a very affordable market. And then you see Grand Rapids, Michigan. So we've got some very affordable markets here. The only one that was unusual was Los Angeles. So
yeah.
I
also
take
San Diego.
San Diego is a little different. San Diego
Yeah.
is seeing a lot of long-term, population growth benefits. So the population there is continuing to grow, but Los Angeles isn't seeing a population growth. Neither is the San Francisco Bay Area. So it's unusual to see Los Angeles in this list. Zillow has more of a sense of balance in terms of hottest real estate markets. So you do see some Southeast markets there, but still Ohio rules. Number 2 on the list, Cincinnati. Number 3, Columbus. And number 8, Cleveland. And so I gave you these markets back in January. So I was like, let me go look at rent growth. It works. Rent growth in Cincinnati, Columbus, and Cleveland is crushing rent growth in the other bubble markets or boomtown markets in this list. So you see Orlando at number 9, you see Atlanta at 10. You see Atlanta at 6, Tampa at 10. You also see Charlotte at number 7. Those are all sort of boom markets, and none of them have strong rent growth right now. It's just the Midwest that has rent growth, and it's there because the Midwest is affordable. Rents haven't gone up this much. So the
And
message right now for people buying, and there's very little supply. So when you look at supply, all of that supply is coming in markets that are at number 6, number 7, number 9, number 10. Those are all Southeast markets. They're seeing huge amounts of supply, and they're seeing rents even retreat backwards. Orlando has negative rent growth. All right, this one's more interesting for people that want the 5-year outlook. Okay, fine, Neal, I know what's happening right now. You explained it, lots of supply, et cetera, et cetera. I want to know what's happening in the next 5 years. Well, this slide is for you. The top 10 boom towns of the future, right? These are some interesting ones. I don't like all of them, so I'll just give you comments on the ones that I think are really interesting to look at. Grand Rapids is definitely a boom town, a lot of tech growth, a lot of good businesses, high quality businesses going in there. San Jose obviously is the incumbent. So they're saying, the number 1 market in the United States might become number 3. It's still there. It's still amazing. Obviously, all the benefits of AI that are happening in San Jose means it's still going to be strong. Knoxville is a terrific market. So 1 million people is the second largest metro in Tennessee after Nashville. This is a market to definitely pay attention to. Oklahoma City is interesting. It's still low on the income side, but there's definitely good things happening there. So if you can just put up with the fact that their incomes are low, it's going in the right direction. I'm not a huge fan of Pittsburgh because it's been in lists for the last 10 years and hasn't done anything useful. But Myrtle Beach in South Carolina, there's just this part of South Carolina that's really doing well. That Myrtle Beach is in South Carolina, but then that same road goes all the way to Wilmington, North Carolina, maybe 100, 150 miles away. There's just a lot of good stuff happening in those markets. If you're looking at the 5-year growth, please note rent growth right now in Myrtle Beach is negative. But if you're looking for the 5-year, that might be a great market to look into. I like to have 2 lists. So I have a second list of top cities that are deemed to be the next Austin. 10 years ago, people were saying, what is the next San Francisco Bay Area? And the answer to that question came out to be Austin. Now people are saying, what is the next Austin? And these 5 markets, I must say all of them are really good picks. Every one of these 5 in its own way is a really, really good pick. Provo and Raleigh are better known, but I still think that they're phenomenal markets to look at. Madison, Wisconsin is a small market that is definitely worth paying attention to. If you like bigger markets, Kansas City, roughly 2 million people, is doing very well. Some of the return of manufacturing from China is going to Kansas City, so there's some growth there. Not the only one that I wouldn't be super sure about is Colorado Springs. So these 5 markets definitely have potential and the potential to grow to become the next Austin potentially. All right. Let's finish off this webinar with my top picks for 2024. I picked these back in January. For those that didn't attend, you'll remember. For those that did attend, you'll remember I picked Grand Rapids, Michigan. So obviously I've been following this city for the last 6 months. Love it. I see nothing to change my picks. Strong value index, affordable cost of living. It's got a very nice and interesting ritzy downtown, some very interesting high-end neighborhoods. A lot of business districts. So whatever is happening in Grand Rapids, I don't live in Michigan, but it seems to be sustainable. There seems to be a lot of growth. So it's amongst the small markets, it's definitely our top pick. And then Raleigh-Durham, I picked this back in January, and I was a little apprehensive because I knew that the Southeast was facing negative rent growth and a lot of supply coming in. And so I was very hesitant to name this in January, even though all the data showed this to be the right one to pick. Well, 6 months later, I have to say, I'm very glad I picked this because it has distinguished itself from all the other boomtown Southeast markets in that it has a huge amount of supply coming in, but its rent growth as of May is a complete class apart from all the other markets. If you look at Atlanta and Orlando and Dallas and Austin and San Antonio and all these other boomtown markets, Jacksonville, they're all here. Their rent growth is all weak or negative. And then we have Raleigh. Raleigh's rent growth in May was 0.5% for a single month. Now, typically you don't annualize that and say it's 6%, but it's clear that Raleigh is doing something different. So this market continues despite a massive amount of new supply to have significant and positive rent growth. So glad I picked it. Very happy with the pick. I think Raleigh is a phenomenal market at this point to invest in. Prices are down there, maybe not 25%, but they're down about 20% for multifamily. So this may be a good time to buy that duplex, fourplex, or sixplex that you were thinking of picking up. And that's it. Just a reminder to everyone that Multifamily U has 20 plus knowledge-driven, power-packed webinars. We archive these. We're doing our next webinar, just so you know, is Airbnb and the STR market. A lot of people have asked me about data for the short-term rental market. And so we're doing a phenomenal webinar on Airbnb, and that one should be ready in the next 45 days, 45 to 60 days. We'll have a powerful webinar. You've never seen Airbnb data from us before. I think you're going to really enjoy that one. All of these are stored on multifamilyu.com. So if you don't know that website, please check it out. And for those of you that haven't seen a pop-up on your screen, this is your time to tell us, fill out our poll. That's how we know whether you're passively interested in passively investing in various kinds of real estate that we buy or build. Thank you for those. About 100 of you have already answered the poll. Please do answer the poll, and we'll be happy to take your questions now. Over to you, Anna.
All right. Well, Christy, who was asking about trends for short-term rentals earlier, she must be very happy to hear that there's going to be a full presentation on it. Any comment you want to say at this point about trends for short-term rentals, Neal?
I will save it, Christy. All I can tell you is that the area is seeing simultaneously some good opportunity and some very troubling political environments that it's going to face in the next year.
Mm-hmm. Why Rochester? It must have been one of the...
Yes. So Rochester came up on one of the slides. The honest answer is this. I bring data to you from various sources. So this is Marker, this is Sphinx, this is Zillow, this is Realtor.com. In general, when I feel that I feel strongly about a market, I tell you its story. And I did that for Grand Rapids here. I told you why Toledo is doing well. Basically, it's one of the most affordable cities in the United States. I don't have an answer for Rochester, New York. So if I haven't studied a city, then I generally don't answer that question. So I'll take a pass on that one. Anna?
What is it that you don't like about Colorado Springs, or why were you a non-believer in Colorado Springs?
I think Colorado Springs is a terrific market, but I'm not ready to call it the next Austin. Okay, so this here marker is saying, well, Colorado Springs has a high chance of becoming the next Austin. There are 1,016 cities in the United States. Only 5 were picked here. When I looked at the data for Colorado Springs, I'm not seeing enough tech growth. To be the next Austin, you have to see more tech growth than Colorado Springs is seeing right now. And keep in mind, it may be seeing more growth than Madison, Wisconsin, but I look at growth from the perspective of population. That's why on this page, you see the population field. Madison only has 687,000 people. Colorado Springs is a little bigger. So Madison might have slightly less tech, but you look at everything from the perspective of the population, and I'm seeing a lot of tech going into Madison, Wisconsin right now.
Are there any cities we should not invest in the next few years?
I think I'm hesitant to make investments at the moment in Florida and also in the parts of Texas that are near Houston. I love Houston. I think it's a great city. I think it's got tremendous growth. The problem is I don't think anybody's figured out what the true cost of insurance should be for Florida and for Texas. And until that is resolved, it will get resolved in some way. The Texas state legislature and the Florida state legislature are going to have to step in to do something about insurance. I think it's completely wacky. It's completely out of control. There are condos in Florida, just so you know, where their HOA is up 1,000%,
Mm-hmm.
10 times. Their HOA has gone up 10 times, right?
That's
So
because of
there's
insurance, yeah, for the
the
condos.
insurance for condos has
Well,
gone completely insane. The market has become, people are selling their condos because they can't afford to keep them, right? And they've been
yeah,
living in those condos for a long time.
right. It's also the requirements to upgrade the buildings based on the Surfside, Florida
That's right.
collapse. And so
Right.
now all of the condos need to upgrade their infrastructure. So it's not just insurance, it's capital calls to improve the structures, which
Yes,
is
and a lot of
very
that
tough.
is tied back to a lot of that is tied back to climate issues. We are seeing,
Yeah.
without getting into this Democrat versus Republican debate, we are seeing stronger hurricanes hit that part of Florida. So I'm a little cautious. We have an investment in Tallahassee. Tallahassee is actually not a city that's ever been hit by a direct Category 4 or Category 5 hurricane. So I guess that part of Florida is a little safer. But in general, my feedback is I'm a little nervous about investing in the part of Texas that's on the Houston side over all of Florida.
Right. Tallahassee is pretty far inland as well.
Yep. Yep.
Why are townhouses the next solution for affordable housing?
The honest answer is this. 10 years ago, 66% of America lived in a single family home. We were unique amongst major economies in the world. Two-thirds of Americans lived in their own home or in a home owned by their family. Only one-third of Americans were renters. I know it sounds like a lot, but it's actually pretty small compared to Europe. That number is growing rapidly. That one-thirds number is going to basically end up at somewhere around 45 to 50%. So what's happening is more and more of the middle income Americans are now becoming renters, where before people below 55K were primarily the renting population. And there were some people that used to like living in Class A. But now the 55 to 85K income level people are also becoming renters. You saw the numbers. The average mortgage in the United States is so high now that incomes are needed. You basically need $115,000 income to qualify for the median home. What if you have an income of 85,000? What if 80,000? Those are medium income people, right? But they're now becoming renters. They don't want to live in apartments. They want a home. Well, single family rentals are astronomically expensive. And so a middle tier is coming in, and that is townhomes for rent. Building townhomes is a lot cheaper than building single family homes. You need a lot less land, but you still get a garage, you still get a small backyard, and you still have nobody above or below you. So you get the three main elements of privacy that people have for single family, but you're still living in a rental townhome. We believe the United States will build somewhere around 1.5 to 2 million rental townhomes in just the next 10 years.
What are your thoughts, your outlook over the next 5 years on ground up developments versus value add investments?
I think both are good. I don't think that the time is right for ground up right now, but I think the next 12 months, as interest rates go down, ground up makes a lot of sense. The big reason for that is we built a lot of ground up developments in 2021, in 2022, and 2023. 2024, you saw that spike, right? You saw that bar, but that bar is going to be much shorter in 2025 because in 2023 rates had already risen, and 2026 that bar is very small. So my answer for ground up is if you can deliver your ground up project in the second half of 2026, you're very lucky. With value add, I'm just generally bullish. Value add, I'm bullish because more and more of America are becoming forever renters. And on the value add side, it makes sense to simply buy and hold. I don't have any belief that our inflation will drop to 2% in the long run. In the short run, I think it will because we've done enough. But if I look at 10-year inflation, I think we're going to be closer to 3% rather than 2%. If 10-year inflation is at 3%, then 10-year rent growth is going to be around 3.5%. Well, 3.5% annual rent growth is something that I would absolutely take in apartments. That's almost a magic number.
What are your thoughts on investing in Detroit, Michigan?
I think the suburbs of Michigan are doing really well. I am known as a Detroit basher, and I think that I've been a little unfair. I've spent more time looking at the metro. So here's what I'll say. I don't like Detroit, but Detroit MSA, Metro, is a good place to invest in. There's lots of good suburbs. You just want to stay away from downtown. I know downtown is going through a revitalization, blah, 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 blah. I don't believe it's going to succeed. Lots of cities spend money on revitalizing downtowns. Most of them don't succeed. But I think the suburbs of Detroit, there's a lot of great suburbs there. It's a large metro, 5 million people.
What markets are landlord friendly?
Less and less, unfortunately. Unfortunately, Californians are, I live in California, by the way, so I love bashing California because I can. I live here. We're sort of infecting other states with our completely batshit crazy ideas on landlord rights and renter rights and squatter rights. This is a real term in California. We now have squatter rights in California, and every squatter knows their rights. The police can't actually come and evict you. You can just randomly walk into a home and take over, and police can't get rid of you. It's bizarre. And that is happening in other markets. Now we're beginning to see parts of Austin, parts of Atlanta have, like today we heard, and this was information Anna provided to me. There are counties in Atlanta, and right, Georgia is supposed to be a red state, where the evictions are now taking 6 months. Who would have thought that would happen in a deep red state like Georgia? But it's happening. So I think one has to be very, very careful to understand and really look at it on a county by county perspective. It's no longer safe to say, XYZ state is landlord friendly or tenant friendly. You really have to look at it on a county by county basis, unfortunately.
Will the freight container price increase affect inflation in the second half of 2024?
There are some small temporary increases in freight prices because of what's going on with piracy. With the Houthi rebels, they're basically shooting at ships. But overall, freight prices are currently roughly, I think, 16% of what they were 2.5 years ago at peak. So they're down about 86%. So freight prices in general are cheap right now. They're very cheap. They've just spiked a little bit because of what's going on in with the rebels shooting at ships that are going through, what is that? The Panama Canal? No, it's not the Panama Canal. It's the Red Sea Canal, basically this narrow areas that ships transit. The rebels are shooting at those ships. So that's responsible for some of the spikes in container prices. It's a very short-term thing. Overall, container prices are way down.
What are your thoughts on the Phoenix and Tucson markets?
I think both of those markets are good. You have to understand, though, that these markets have built a lot. So there's a lot of supply coming in Phoenix in the second half of this year and the first half of next year. So it'll take time for those to be absorbed. So all I would say is it may not be time. Phoenix and Tucson are not ready to buy yet. I would say you still have time, maybe buy in Q1, Q2, maybe Q3 next year. And then you can be basically, you're pretty sure that you're at the bottom and you're at the beginning of the next cycle. They're just sort of late in the cycle because there's a lot of new construction.
What about north of Dallas towards Oklahoma City? There's a lot of investments and new jobs, favorable property tax. Do you feel bullish about that area?
Yes, as long as it's really favorable property tax. So one of the things is, if San Antonio's at 1.53% of property taxes and these places are 1.3%, that's not favorable property taxes. That's only a relative number. I'd like to see property taxes in those areas at 1%. And if they're at 1%, sure, you can call them favorable. So do your research. Those markets are slowing. I think that there's still better deals to come in all of the markets. So is it Denton? So on the Denton side, I'm beginning to see some discounts. I still think that there's more discounts coming. And then if you're on the Provo, not the Provo side, what am I thinking about? Plano and then McKinney, I still think that there's more discounts to come there. So you might want to wait a little bit.
How should one think about and factor in climate change and insurance rates when thinking about cities with long-term tailwinds?
I think I gave you the answer to that question before. I think Florida and East Texas are going to face problems. Most of the other insurance adjustments have happened. We are now seeing anecdotal evidence, it's anecdotal, of some properties actually seeing lower insurance rates for 2024 because we've been in the great insurance reset now for 3 years. And while I don't know how East Texas and Florida are going to do with insurance, but other markets are beginning to adjust. And I think going forward, we probably will still see 5, 6, 7% growth in insurance, but it's not going to be 10 double-digit numbers of the sort that we've seen. I think that adjustment on a nationwide basis has largely happened.
Is Southern California a good market for multifamily investment?
Sure, sort of. The answer is depends. I think I still see Riverside and the Inland Empire as a better market than Los Angeles.
Or
So those are
Sacramento? That was
markets.
another question, was what about Sacramento? So maybe include that in
Well,
your answer.
yes, I'll do that. But the question was about Southern California, so I'd stick with Riverside and Inland Empire. Sacramento, no. I at this point, Sacramento is I wouldn't say it's melting down, but it's seeing some price discounts. I would wait. I don't think that Sacramento is bottoming out.
Let's see. How do you suggest LPs evaluate providing capital for interest rate cap purchases? Are there good opportunities to invest in preferred equity in today's market?
Yeah, if you're paranoid about how your investments might do, you might just want to invest in properties that have assumable loans. Obviously, there you're getting the benefit of the discounts. We're currently seeing 25% discounts, but not the reason for the discounting, which is high interest rates, because you're assuming a low rate loan. So you might want to invest in a tier called pref equity in properties that have sub 5% assumable loans. Then you get the discounts, but not the reason for the discount. That probably is the best investment going. I wish I had some to offer of that description, but those are pretty good.
What are your views on self-storage, especially in tier 2 and 3 markets, as an entry strategy for commercial real estate?
May not be the best time. So the self-storage market did really, really well in the first year where that rates went up. Now they're really beginning to adjust. So self-storage rents are negative on a US basis. So we're seeing weakness in that market. Since the weakness is recent, I just don't think that self-storage prices have adjusted. So multifamily adjusted very quickly. So basically, as interest rates went up, prices went down. It was a very smooth process. I still think multifamily might adjust another 5%, but self-storage prices took a while to adjust. And so I don't think they've fallen enough.
This person says they have heard news articles that Daytona Beach is going down in the next 5 years, but it was on the 5-year hottest market. Any comment on that?
The 5-year hottest market doesn't necessarily look at the challenges of insurance. So I would dispute that Daytona Beach is going to see huge price increases on the single family or multifamily side because they still have to resolve their insurance issues. I think Daytona has significant issues. So I agree with you that maybe it should not be on the list because I think they're just looking at population growth and job growth, and Daytona's got plenty of those. But look, we're real estate investors. We have to look at things like insurance. The expense side in Florida is just not getting resolved.
So I'm going to combine these two questions. What do you think of Jacksonville land? I guess, oh no, what do you think of Jacksonville? And where would you say the multifamily market is in Florida in terms of selling? Are prices dropping?
Absolutely. Prices in Jacksonville are dropping fast and will continue to drop. I don't think Jacksonville has bottomed out. It has a lot of new construction. That new construction is going to continue to come in the next 6 to 12 months. I'd say don't buy in Jacksonville for another year. I think that you'll get plenty of deals in Jacksonville even 1 year from now because that market is not close to bottoming out. It's a good market. It's from a growth perspective, a success story. But from a supply perspective, I don't think its prices have dropped enough. I think that's going to be lots of room. Be patient. There's plenty of room. Florida is not anywhere close to its bottom prices. The US multifamily market is close to its bottom, and this quarter, next quarter are likely to be the bottom quarters when all is said and done. I don't think Florida's there yet.
Are there still large BTR funds, REITs, et cetera, people looking to buy BTR?
They're just not looking to buy at today's prices. So we are seeing no no demand destruction for BTR. In fact, I think there's more funds now than before. The challenge, of course, is those funds don't want to buy 4-cap properties. They don't want to buy 5-cap properties. They want to buy 5.5. They want to buy 6-cap. So I think a lot of their money is still the powder still on the sidelines. But there's a huge amount of interest. Yeah, they just want to pay less.
Which area of Myrtle Beach do you recommend? The city or the suburb between Myrtle Beach and Wilmington?
On the part that goes out towards Wilmington. So as you're leaving Myrtle Beach, going out towards Wilmington may be a better buy than the city itself. I'm not an expert.
Yeah, that is further away from the ocean, so that would be good in terms of hurricanes.
Insurance, yeah.
Yeah, and insurance. Any opinions on the state of Connecticut?
Connecticut is hollowing out. I think, there's 7 people living there. One of them is Michael Bolton. I think when he dies, that's it. That's the end for the state. I mean, jokes aside, Connecticut does not have a good future.
We are just a couple more, Neal. We're pretty much at time. Let's see. What do you think about developing condos around national parks as a strategy?
No comment. That was, 2 very interesting things mixed together, but I didn't expect them to see next to each other. So no comment.
Oh, thoughts on Las Vegas and Reno multifamily markets?
I think those are good markets. They're both very strong markets. They're both markets to look at. Nevada's just benefiting from the fact that both its insurance and property taxes are very low compared to the rest of the US. And a lot of people like me are basically beginning to make their investment decisions based on which state has both low property taxes and low insurance. Nevada happens to be that state. I mean, Reno and Vegas are really the only 2 markets in the state of Nevada. So Nevada is getting a lot of attention. Now, it does have supply. Reno has less supply than in Las Vegas, but there's supply here. So I'd say I think there's a lot of opportunity in both of those markets. Maybe wait until the first half of 2025. So you allow some of that supply to come in and rent growth to start to pick up.
Let's see. Memphis, Tennessee.
I'm not very fond of Memphis for one simple reason. So Tennessee has 4 strong markets, right? With Memphis being at the bottom of that list. I mean, you've got Nashville, you've got Knoxville, you've got Chattanooga, and you've got Memphis. What's common between the 4 of them, right? They're pretty large markets. What's not common? Well, 3 of them have significant population growth: Chattanooga, Nashville, and Knoxville. Memphis loses population. So in the same state, why would you want to pick the one city that's losing population to the other 3 cities? That's my question for you.
Let's see. A couple of people are asking about luxury apartments. What do you think about, luxury apartment projects in 2025? Do you think that'll be a good time for luxury apartments to come to market?
No, I don't think so. I think that you shouldn't be starting on construction of luxury apartments in the next 2 to 3 years. I think that's a dangerous area.
All right, Neal, I will let you take a spin and choose one question, and we are at time.
All right. Okay. I'll take Palm Beach. So Palm Beach County, where do you see us in the cycle in Palm Beach County? I don't think Palm Beach has bottomed, Marcus. I think you might see significant price reductions in Palm Beach in the coming 6 months. So I'd say bottom maybe maybe Q1 of next year is the likely single family bottom, and then multifamily maybe a little bit after that. Florida's just late on bottoming on everything. So I'll take that as the last question. But thank you, everyone. There's still close to 300 of you in here listening to us. Thanks for coming. Hope you enjoyed this particular update. Once again, we will have the Airbnb and STR. This is a brand new webinar for us coming up, I think, in about 30 to 45 days. So stay tuned for that. And thank you, Anna, for keeping me company. Thanks, everyone.